Hello, everybody. Welcome to Collective Investments. Buy and hold US broad market index is the most important investment strategy that this channel advocates. And this is a very strong statement. Although it's easy to operate, if you don't know why, you may not have enough confidence. You may not able to buy and hold and enjoy the long-term return of US broad market index. So there are many questions embedded in this statement. For example, why it's US stock market? And the last week's video, we talk about this because US stock market is the biggest, it has the best liquidity, and also the highest historical returns. And I believe because it has the best companies, it will continue to give us the highest returns in the future. And the second question is why we need to buy and hold. We'll talk about this next time. And finally, why we need to buy and hold broad market index. What about individual stocks? Can I find individual stocks and not use market index? Can I trade individual stocks and beat the broad market index? Let's discuss this question. Okay, can I pick stocks and beat index? It's possible, but it's a very difficult job. So Peter Lynch has a famous book called Beating the Street. Basically, it teaches us average people how to trade stocks and to beat the Wall Street, which means to beat the market index. It's a very fun book. And by reading that book, you'll know how hard it is to pick good stocks. And also, if you look at the legendary stock pickers, there are not many of them. And some famous ones like Warren Buffett, Peter Lynch, and a few more. Look at these names and the years. So, except Warren Buffett, all other stock pickers, they stopped managing money more than 30 years ago. So, which means recently we no longer have a good stock picker. And we know there are many money managers. And still, we no longer see very famous stock pickers these days. And even for Warren Buffett, the Berkshire Hathaway he manages, in the last 20 years, have very similar performance as S&P 500. And remember, Berkshire Hathaway is an insurance company, and they have a lot of extra cash. So basically, they can invest in the market at 1.6x leverage. With this extra leverage, they still didn't beat S&P 500 in the last 20 years. So what happened in the last 20 or 30 years? Looks like the good old days are gone. 30 years ago, there are still some stock pickers, although it's already extremely rare. But after that, we don't hear any. What happened? If you look at earlier history, Benjamin Graham, which is a mentor of Warren Buffett, and he has a very famous net rule. Basically, he only wants to buy stocks which is really cheap. How cheap? Well, you sell the company's assets and you pay off the liabilities, and then the two-thirds of that money is still more than the stock market value of that company. This often means a company that's very undervalued. If you look at today's company, we can no longer find companies that's very undervalued. And if you follow Graham's rule, you're gonna never able to find a stock to trade. So why is that? I believe it's because the institutional traders or professionals, they are increasing over the years. And they actually increase quite a lot. So 70 years ago, most of the traders are retailers, are average people, and less than 10% is institutional traders. And since 2000, there's already 60% institutional traders. And in recent years, it's even getting closer to 80%. So this is a big change. And from this trend, we can tell the institutional traders dominate the market now. So what happens when most of the players in the market are professionals? Let's use an analogy. If you look at the AlphaGo story almost 10 years ago, AlphaGo can beat all human players. And if AlphaGo play with other human, AlphaGo can always win. But what if 80% of the players in the market are all AlphaGo? They're gonna play with each other most of the time, and likely they get a win rate of 50%. And it is very hard to find a winner that beat all other professionals. So in the stock market, this means with so many professional players, the good opportunities will disappear very quickly. And no big companies can stay undervalued or overvalued for a long time. Why? Because there are enough professionals research those big companies. And there are so many professionals. They are all smart, hardworking. They have the best tools available. So no one professional can beat other professionals for a long time. So that means overall, because of all the hard work of the professionals, on average, each professional player approaches the performance of the broad market index, or the sum of all the professional players, their total return before all the fees is close to the broad market index. But because they have to charge management fee, then it becomes a negative sum game. And then their fund over the long term becomes very hard to beat the broad market index. So I'm not saying that there's no hope for retail traders to pick good stocks and beat market index. I just think it's much, much harder. Maybe you need to avoid the big companies. You need to spend a lot of time to study many smaller companies that the professionals didn't have time to research. But anyway, it's a very difficult job today. And if you just use the broad market index, maybe you get most of the return with very minimal time. And I think it's a very worthwhile to invest in the US stock market. Okay, that's all for today. Thank you.